All right, we're on the Reading Exchange Traded Funds, Mechanics and Applications, LOSA. Really interesting one. Explain the creation redemption process of ETFs and the function of authorized participants. And to appreciate how ETFs are created and redeemed, let's contrast it with a typical mutual fund to begin with, because the ETF really is like a mutual fund, but exchange traded, and it's the creation redemption process that really sets it apart. So for a mutual fund, mutual funds issue shares or what are called units, trust units. And if you're buying shares or units of a mutual fund, you buy them from the mutual fund itself. And you redeem them with the mutual fund itself. So let's say that you call your mutual fund dealer at 10:30 in the morning and say, I want 1,000 shares of this mutual fund. He doesn't know how much it costs, or she doesn't know how much it costs at that point. You have to wait till the end of the day to get a closing net asset value on the fund, and that's the value per unit or the value per share that you'll pay. So if you want to put $5,000 in the mutual fund, the number of units or shares you get will be known at closing time. And the mutual fund creates and redeems all the shares or units at closing, the closing net asset value. And that's a rule. Mutual funds must redeem and create all the shares at net asset value. ETFs, on the other hand, trade on an exchange. They trade all day long. So if you want to buy 5,000 shares of an ETF at 10:30, you simply just have to look at the quote in the market. There's a bid and an ask, and you just have to take that price, divide your 5,000 by that price, and that's how many shares you're going to get. You pretty much know. When you're buying shares on an exchange of an ETF, you're just buying them from somebody else who happens to be selling them. You're not buying or selling with the ETF company. Much like you would with the mutual fund company, you're buying and selling on the exchange with other investors. There are institutions called authorized participants that can create and redeem the ETF shares. The ETF company itself does not get involved in going out in the market and buying the underlying shares every time somebody buys ETF shares. So the ETF shares trade intraday on an exchange, and the ETF shares are created and redeemed continuously in kind in a shares for shares swap by the authorized participants. So let's look at how this is done. In what's called the OTC market, OTC means over the counter, means not done on an exchange. An authorized participant will buy up the types of shares that the ETF holds, and then after the market closes, they swap. The authorized participant will hand over all the shares to the ETF dealer, and the ETF dealer will hand over ETF shares. And that's called over the counter because that swap is not done on an exchange. So let's look at a process. Here's our authorized participant on this side. Here's our ETF sponsor on this side. Each day, the ETF sponsor will specify and publish what's called a creation basket. And the creation basket are all the shares that it holds in the weights that it holds. And when we say each day it publishes the creation basket, it's because it can pick and choose what types of securities it wants in there for tax efficiency reasons. We don't have to get into that right now. We will later on. Let's just keep in mind that this creation basket isn't necessarily the same all the time. So it specifies and publishes each day a creation basket. The authorized participant can look at this and say, okay, well, I'm going to keep my eye on the ETF price, and I'm going to keep my eye on what it would cost me to create this basket of shares. And when these two things get out of line in pricing, there's an arbitrage opportunity. I can either buy up all the underlying shares and short the ETFs, deliver the underlying shares and get the ETF shares to cover my short position, or I can buy up the ETF shares in the marketplace and short the underlying creation basket in the market, deliver the ETF shares and get the creation basket delivered to me. So that's a lot to take in, so let's go through it step by step. So let's say in this creation basket there are two shares. Give me one share of ABC and one share of XYZ, and that's it. So the authorized participant will buy one share of ABC, one share of XYZ, and after the market closes, deliver it to the ETF company. The ETF company will in turn deliver ETF shares. The authorized participant is then free to sell those ETF shares in the market. So this is called a creation unit. Whenever they create ETF shares, it's called a creation unit. The creation unit is typically for 50,000 shares. So it wouldn't be one ABC and one XYZ. It might be 1,000 ABC and 1,000 XYZ. Again, just a rough example that are required to equal 50,000 shares of the ETF. The authorized participant gets the ETF shares and then can sell them in the market. So it will purchase to deliver, and delivery is after the close. This creation basket gives it to the ETF sponsor. The ETF sponsor gives the authorized participant the ETF shares. Now, that also works in reverse. The authorized participant can buy up a whole bunch of ETF shares, deliver the ETF shares to the ETF sponsor, which then delivers the creation basket to the authorized participant, who can then sell those. So obviously the big question is, why would an authorized participant bother making a market in ETF shares if that's all they're doing, buying the underlying, delivering them, getting them the shares, selling them? Are they doing all of that just to get the bid-ask spread on the ETF? And if that's the case, aren't they paying the bid-ask spread on the underlying? It doesn't seem to make a lot of sense. Where's the money in this? And the money is in arbitrage. And the ETF sponsor relies on this process. So what it says is, look, our shares trade in the market. There's nothing in the market that will hold our shares close to the net asset value of the ETF unless there's an arbitrage opportunity. And that's what the creation and redemption process is a creation of an arbitrage opportunity such that dealers will then take advantage of it, and that's how shares, ETF shares, are created and redeemed. So let's just go through an example. We'll go through two examples, one where the ETF share is overpriced or underpriced. Let's say the authorized participant sees ETF shares trading in the market at $25.10. It looks at the creation basket published that day, and its screen is telling it that the fair value right now, if it bought all of the units in the creation basket, the fair value would end up being $25 per share based on what the ETF has. So the dealer looks at this and says, well, the ETF shares are $25.10. I can create ETF shares at $25 a share. I'm going to follow this rule of buy low, sell high. Where's the low side? $25. So I'm going to buy all the shares in the creation basket, and I'm going to short the ETF shares. So first step, sell 50,000 shares at $25.10, and I will get some money in my account when I short those shares. I will take that money and I will buy the creation basket for $12.50, and I will make $5,000. At the end of the day, after the market closes, I take all the shares that I bought and I deliver them to the ETF sponsor. The ETF sponsor gives me 50,000 shares. Now remember here, I started by shorting 50,000 shares. Well, the ETF sponsor is going to give me 50,000 shares. That 50,000 shares now covers my short position. I'm clean. I make $5,000. Now doing this, now notice what we're doing here. We're selling 50,000 shares. So this will start to push the price of the ETF down. And we're buying the underlying shares in the creation basket. So this will start to push the price of these shares up to the point where there is no arbitrage anymore. And that's how the ETF shares trading intraday in the market stay very, very close to what the intraday net asset value is. Let's go the other way. Let's say the ETF shares are $24.90 and the fair value of the creation basket is $25. Buy low, sell high. Which is the low side? $24.90. So we're going to go buy 50,000 ETF shares, and we're going to spend $1,245,000. And we're going to short the creation basket because it's too high. So we're going to sell all the shares that would fit in this creation basket, and we'll get $1,250 for a gain of $5,000. At the end of the day, we'll take these 50,000 ETF shares that we bought and we'll deliver them to the ETF sponsor, who will then deliver us all the shares in the redemption basket. And since we sold all those shares short, we get them, and that will cover our short position. End result is we make $5,000. So it's the arbitrage opportunity that allows the authorized participants to engage in a creation and redemption process, not just for the benefit of the market, it's for the benefit of themselves. And in benefiting themselves and taking advantage of these arbitrage opportunities, it keeps those two values very, very close in line, so that when you go to the market and you buy an ETF share that's trading on the market, you know that there are a bunch of authorized participants working to keep that share price very close to the actual net asset value of the ETF itself. And there's always something called an arbitrage gap. It doesn't always make sense to do this. Let's say instead of $24.90 and $25, it was $24.99 and 25. And the dealer does a quick calculation, says, you know what, after all transaction costs, I'm only going to break even. Well, then it's within the arbitrage gap. It's not going to be taken advantage of. So these are the arbitrage gap are prices at which arbitrage makes sense. So the gap may be plus or minus 5 cents. So if the creation fair value of the creation basket is $25, maybe arbitrage only makes sense below $24.95 and above $25.05. And each ETF will have its own arbitrage gap depending on the bid-ask spreads of the underlying, how liquid the underlying is, how easy it is to get. So the tighter the spreads on the underlying, the more liquid those markets, the tighter the arbitrage gap would be. Varies with the liquidity of the underlying. So we'll just tie up a few loose ends in LOSA before moving on to LOSB here. The dealer bid-ask spread on the ETF. Now remember, the dealer, the authorized participant, which we now call the dealer, gets ETF shares from the ETF sponsor and then sells that in the market and stands ready to buy and sell shares of the ETF. Well, there's a bid-ask spread. That's determined by the cost of arbitrage. The more expensive it is to arbitrage, the wider the spread will be on the ETF itself, and a risk premium for volatility and liquidity risk. And this means that depending on the nature of the underlying, if the ETF, the dealer itself, not the sponsor now, if the dealer itself has to hold shares of the ETF in inventory with a volatile underlying, well, then there's a cost. There's a risk associated with that volatility. Same with liquidity, so the bid-ask spread will be wider. The authorized participant absorbs all the costs of transacting the securities in the creation basket. Therefore, non-transacting ETF holders are shielded from the negative impact of these transaction costs. This is not true with a mutual fund. Let me give you a very quick example. Let's say that there are 3 people in a mutual fund, and the mutual fund holds a whole bunch of shares, and that circle represents the whole portfolio of the mutual fund. And one of these people says, I want out. And gives the mutual fund dealer a redemption request to redeem, and let's say it was, it's just a contrived example, but 20% of the fund. Well, the mutual fund dealer then has to sell securities which may create capital gains. And all the costs of selling those securities are borne by all 3 participants, not just the one that wants out. So the 2 that are going to stay still have to pay those transaction costs. It gets deducted from their return. And at the end of the year, they have this capital gains tax that they have to pay, that had that other person not left, they wouldn't have paid it. So in a mutual fund, every transaction is a shared expense of everyone in there. But with an ETF, since the dealer absorbs all the costs of transacting the securities in the creation basket, only ETF holders who are buying or selling at that particular time absorb the cost of that particular creation unit, and it's in the bid-ask spread. So non-transacting ETF holders are shielded from the negative impact of these transaction costs because it's not the ETF sponsor that pays the transaction costs. It's the authorized participant that pays all the transaction costs and then recovers those transaction costs in that bid-ask spread. And the only people experiencing that bid-ask spread are people who happen to be buying or selling at that particular time. So what are the results here? The ETF operates at lower costs, greater tax efficiency, and because of this arbitrage opportunity, ETF prices are kept in line with net asset value. So that's how shares of the ETF are created in what's called the primary market. And the primary market is an OTC market. That's between the authorized participant and the ETF dealer. I did mention that when individuals buy ETFs, they're buying them on an exchange. Well, exchanges are secondary markets, which is what LOSB is asking us to do here. Describe how ETFs are traded in secondary markets. Not a lot of describing to do here. Same as any other share of any company traded on any exchange, you just buy and sell. Investor to investor on an exchange, settlement is the same as any other listed stocks. It's T+2. One thing to note here, authorized participants may have up to 6 days settlement due to the time required to create or borrow the ETF shares. Because of that creation process, they may have more time to settle their trades, but for just the regular investor in the market buying ETF shares on an exchange, it's just the same as buying any other stock. LOSC describes sources of tracking error for ETFs. And we'll lead into this nice and slow. We'll build up on this. Let's look at some expense ratios for ETFs. They are much lower than mutual funds, and they're actually quite shockingly low, believe it or not. They're much lower than mutual funds for a number of reasons. Number one, there's no shareholder record keeping. The ETF sponsor doesn't know who owns the ETF shares and doesn't care. Whereas a mutual fund sponsor, a mutual fund company, has to keep a record of everyone who owns what trust units and what they're worth at any particular time, and has to incur communication costs with all of the people who hold the trust units as well. And because they're obviously trying to do something, they get involved in active research. ETFs don't have any of that. No shareholder record keeping, so that takes a huge expense off. No communication costs with any ETF holders. That's for your broker to do for you. No active research. So if we look at broad-based cap-weighted indexes, any ETFs that track any broad-based cap-weighted index, and the biggest one in the US is the SPY. This tracks the S&P 500. Look at these expense ratios, 0.03% on US equities. That's not 0.03 isn't 3%, that's 0.03%. 0.04% for US bonds, 0.11% for emerging market equities. Compare that with some of the expenses, management expenses or expense ratios, the MER for mutual funds. ETF managers attempt to track an index as closely as possible after fees. Now, this tracking of the index, this is typically evaluated using daily return differences between the ETF and the index to determine how successful the ETF manager is at tracking that index. We just look at the difference between the daily return differences between whatever the ETF offers and whatever the index did. The standard deviation of this difference is called tracking error, and tracking error is usually stated for a 12-month period. And the expectation is that if it's an index fund, and an index fund really is just a passive tracking vehicle. It says, look, here is a nice low-cost way to get exposure to just this index, and I'm not really going to do anything. I'm just really going to deliver the return on this index. The expectation is that the index fund would underperform its benchmark on an annual basis by the amount of its expense ratio. So if you're looking at the SPY, you'd underperform. The expectation is you're going to underperform by 0.03% at least, because the S&P index itself does not have expenses. Let's look at some sources of tracking error. I have 5 of them on the screen. In blue, all the points that I made in blue here are sources of tracking error. The first one, obviously, fees and expenses. If you're buying and selling the actual shares, you're not going to be able to be costless. There are transaction costs associated. Representative sampling and optimization. Sometimes, especially for bond ETFs, full replication is really not possible or even optimal. Sometimes you have very illiquid underlying securities, again, especially in bond indexes where full replication is simply just not going to be possible. So you do a sampling and you try to have a sample of the securities that represent as much of the variation in the returns as you possibly can before you start to get so complex that the costs begin to outweigh the benefits. So sampling and optimization, full replication may not be optimal or possible for large indexes, especially fixed income. Well, if you don't have 100% replication, you're not going to have 100% replication of the return. You might get 99.4% of the return. You might get that close, but that's a source of tracking error. And this is the thing about sampling and optimization. It can enhance or detract from ETF returns depending on whether the holdings over or underperform those in the index. So if the index has, let's say, 1,500 components, and that's not uncommon in a bond fund, and the ETF decides that it can get very, very close to the same returns by only holding 200. If these 200 tend to overperform and the others tend to underperform, this actually would be a benefit. The tracking error would not end up underperforming, but now you'd be overperforming. But that's still called tracking error because you're supposed to return the index return. So any deviation from that is tracking error. But hey, listen, if tracking error benefits me, I'll take it, right? Depository receipts and ETFs. This means that an ETF, rather than holding the underlying itself may find that it's better to hold a depository receipt or to hold other ETFs instead of holding the underlying shares in those ETFs. So ETFs may hold shares that are different than those in the index. So if you're holding the depository receipt or the ETF as opposed to the shares themselves, well, this ETF will have tracking error, which means if you're holding the ETF, you'll have tracking error based on that tracking error. Index changes. ETFs may add or eliminate constituents at different times or at different prices than the index. And fund accounting practice. And this deals with valuation times each day, and they may be different from the index. So, for example, some markets may have a 2:30 closing, and that will be the time at which they strike the price, the closing price. Some markets have 4 o'clock closing. Some markets have a 5 o'clock closing. So if the ETF decides that they're going to follow a 4 o'clock closing and they strike prices at 4 o'clock to determine NAV, even though this would be the closing price in the commodities market, the commodities market still trades after 2:30. It's just when the bell hits 2:30 in that market, that closing price at 2:30 becomes the closing price of the commodity, but the commodity still trades. So at 4 o'clock, it may have a different price than it had at 2:30. And again, for currencies, for example, if you strike them at 4 o'clock, it'll have a different price than it would at 5 o'clock. So depending on what time of day you make that valuation, you might have tracking error from day to day. Two more sources of tracking error: regulatory and tax requirements. And this is primarily for ETFs that hold shares of stock listed on exchanges in different countries. Typically, there'll be a foreign dividend withholding tax that the ETF would then have to pay. Asset manager operations. This is securities lending. Sometimes the ETF dealer or the ETF sponsor will say, well, you know, since we're long-term holders of these securities, we don't mind lending them out. Well, there's income associated with that. And then foreign dividend recapture. Even though the foreign dividend can be withheld, depending on how your tax returns are structured, you can apply to the country that withheld it to have it refunded. Some tax issues, and I don't know that the learning objective really expects us to go through the tax issues. It seems to fall outside the scope of it, but I can get it done in half a screen here, so let's just cover it anyways. Capital gains distribution. Funds must distribute any capital gains realized during the year, but it's usually low. For mutual funds, that's true. They distribute the capital gains throughout the year. So when you get your distribution report at the end of the year, it tells you how much was interest income, how much was dividends, how much was capital gains. ETFs do the same thing. At the end of the year, you get a report from your ETF holdings saying how much of your returns were capital gains that you have to claim. But it's usually very, very low for a couple of reasons. Number one, tax fairness. ETF investors sell to other ETF investors. It does not require the fund to sell assets to meet redemptions. So you have a lower turnover in the fund simply because if you're trying to sell your shares, you just sell them to somebody else. The ETF sponsor itself does not have to incur any capital gains activity by selling anything because it doesn't have to. ETF shares are created and redeemed in kind, and anytime something is created or redeemed in kind, that is not a taxable event. So I deliver to you this, and you deliver to me this. That's not a taxable event. It's just whatever the fair value of that transaction is, that becomes the new carrying value. So because of that, ETFs have tax efficiency. They can use shares with the largest unrealized capital gains in the redemption process. Capital gains occur from, if we just stick with the index itself, it does create capital gains. The redemption process doesn't get rid of all the capital gains. It'll continually raise your your average cost basis on all your holdings so that you're always at any given time holding the lowest amount of capital gains, but they still occur because there's index reconstitution and index rebalancing. So the ETF fund itself at some point would have to either delete a holding that it has because the index has deleted it. Well, you got to sell it, and maybe there's a capital gain tied up in there, and same with rebalancing. Other distributions, dividends. LOSD describe factors affecting ETF bid-ask spreads, and this LOS is embedded into a larger discussion about ETF trading costs. You'll recall earlier we said that mutual funds acquire and redeem their shares or their units at whatever the end of day net asset value is. For an ETF, we also saw that the authorized participants can engage in arbitrage to keep the ETF price very close to its net asset value. And it does this by either buying ETF shares or selling ETF shares in a creation or redemption process. And they can do that anytime the exchange is open. The closing price on an ETF may include a premium or discount to the closing net asset value of the ETF fund, even though there's arbitrage available and to keep the price within a tight range of NAV, of NAV. They still may close at either a premium or a discount. And that's because of two particular reasons. One is called market structure. The other is called the liquidity or slash the volatility of the underlying. So we'll look at each one. Commissions plus trading costs are involved with ETFs, and trading costs are the bid-ask spread and market impact. And we're really just going to focus on the bid-ask spread. We have a whole reading coming up in this section that will get us more into detail about what market impact is and how we measure that. But for now, let's look at at the bid-ask spread. For an ETF, the major impact on the bid-ask spread or the size of the spread comes from market structure or the liquidity of the underlying. So to make the point on that, let's have a look at this little chart replicated from the reading. We have the U.S. traded ETF category, the first one and the third one. Notice that we have U.S. equity and U.S. fixed income. Let's use that as our benchmark here. And have a look at U.S. equity. The median spread, and this is asset weighted. In other words, you take the spread and you divide it by the value of the underlying, whatever the value is. 0.16% for U.S. fixed income, 0.14%. But when we get into international equity and international fixed income, notice the jump, 0.24%. Much higher than it is for U.S. equity and U.S. fixed income. And the reason is the underlying securities trade in different markets. So while the authorized participant can engage in arbitrage in the local market to keep the ETF price within some arbitrage-free range, what happens if the creation basket dictates that certain stocks must be delivered that trade on an exchange that's now closed? Well, you can't buy or sell that one. So you can't really complete the creation or redemption process on this one. It makes it difficult to price out simultaneously. So a dealer looking at a screen at any time says, well, I can see the ETF price and the fair value of the creation basket is, well, I don't know because these other stocks are trading in a market that's now closed. So I only have the previous closing price. If the market were open, given the events that have happened, chances are it wouldn't be trading at that closed price. It would be trading at some different price. So I can't come up with a number that makes a lot of sense unless I already have it in inventory. And if that's the case, well, guess what? Those spreads are going to have to be wider to account for that uncertainty. And there it is right there, 0.24% on anything international. Look at this one down here, 0.32%. Why? Leverage. So whenever you're using leverage, you're using futures to gain that leverage. Well, futures has a different market close than regular equities, and it's structured differently. So look at the size of that spread, 0.32, and all the way up to alternatives, 0.38. And why alternatives so much? Well, the underlying is very illiquid. So it's hard to move into and out of to create arbitrage. And whenever you have illiquid securities, the costs, the transaction costs of trading in that security increase. Hence, if the only participants who are affected by the creation redemption process in ETFs are those who are transacting in the stock, you must have a wider bid-ask spread to account for that extra cost. Look at some other bid-ask spread width factors, the spread width factors. ETF liquidity, the liquidity of the ETF itself, and like all other assets that trade on the market, the more liquidity there is, the tighter the bid-ask spread, so the more volume, lower spreads. Market maker competition. If I'm the only game in town, I can hold wide spreads, no one's competing with me. That's my profit spread. More competition, lower spreads, obviously. Costs or risks associated for the market maker or the authorized participant. This includes hedging risk and the risk of inventory. So let's say an ETF, we'll put ETF A, tracks index A. And there are futures contracts on index A. If there are futures contracts on index A and we're holding ETFs in inventory and we don't want that risk, we can use futures contracts to hedge out that risk. And because we can do that, we can lower our costs and lower our risks with holding inventory. If there are futures on the index, you'll have a lower spread. If there are no futures on the index that the ETF is tracking, if that's not an option, hedging becomes, well, almost non-existent to very expensive to do. Hence, holding inventory becomes risky. If I'm going to do something risky, I need to be compensated. There'd be a wider spread. Plus, spreads tend to widen when market volatility increases or when information relating to the underlying index securities is expected. This one is not such a big one unless the ETF is holding a very low number of underlying securities. But if you take something like the SPY, and let's say that 2 or 3 components are expected to report earnings in the morning, it's not going to do much to affect the bid-ask spread because 1 or 2 or even 3 components out of all of the components that the SPY holds is not enough to significantly influence that spread. But let's just be aware that not all ETFs have the number of components of the SPY. Some ETFs have as little as 15 to 20 components. So if 2 or 3 components during an earnings season are expected to report earnings before or after the bell, the spread would probably be wider to reflect expected volatility in some of the underlying components. LOSE describes sources of ETF premiums and discounts. And for here, we have to look at it from 2 points of view, one during the day and one after the market closes. So let's draw a timeline here, and let's put a little stick here denoting the close of the market. And during the trading day, we have an intraday price on the ETF that we can observe on the exchange. After close, we have a closing price on the ETF. And we compare these prices with 2 different measures of NAV. During intraday, we'll compare it to what's called indicated NAV, indicated net asset value. And this is the intraday fair value estimate based on the creation basket of the ETF for that day. So the authorized participant would have up on their screen an indicated NAV that's based on an algorithm that says, okay, well, this is the creation basket for the day. Let me go and find these prices, real-time prices, and at any point in time, I'll give you a real-time value of what the ETF share would be based on its indicated NAV, and you can compare it to the intraday price. So intraday, you can have premiums or discounts. If the ETF price is greater than indicated NAV, you have a premium. If it's lower, you have a discount. Arbitrage takes care of that. So during intraday, if arbitrage can step in and take care of that, it will. Then you have a closing price, and you'll compare that to the end-of-day NAV for the ETF. And the end-of-day NAV is the most accurate assessment of fair value if the underlying securities trade on the same exchange. So let's take something like SPY. SPY and all the underlying securities trade in the same market and have the same closing price. So the closing price on SPY at the end of the day is the most accurate fair value estimate of what that basket of securities is worth. Same market structure, same closing price. Same closing time. So if you have a closing price on an ETF that's different from the end of day NAV, you can either have a premium or discount, the ETF price greater than NAV or the ETF price less than NAV. This will usually arise because there is some breakdown in market structure or some breakdown in closing time. And by breakdown, I mean that the underlying and the ETF are not trading in the same market or the same types of markets or have different closing times. So let's have a look at timing differences. Differences in closing times between the ETF and the underlying. So if there's an ETF that has international stocks and you're looking at the end of day NAV, well, the end of day NAV would be reflective in part of the securities that trade in the same market as the ETF. But what about the securities that were closed while this market was open? Those are stale prices. And especially if fundamental economic global news has come out during the time that the previous market closed, those prices may not reflect what those securities would trade at if the market were open. So it may appear to trade at a premium or a discount. Like I say appear, it may appear to trade at a premium or discount only because other security prices haven't caught up with where the rest of the world is in terms of the news that's out. Bonds are a good example of this. There's no true closing price available for a bond, so a bond ETF would pick what time of day? 3, 4, 5? To strike the closing prices to come up with a NAV. Would they all have the same? So if you're comparing 3 bond funds, do they all use the same closing price? If they don't and they use different closing prices, some may appear to be at premiums or discounts to their underlying when in fact they're not. It's just a structural difference. May have stale pricing, so that an ETF, a bond ETF, may say, well, we'll strike our closing prices at 3 o'clock, but some corporate bonds don't trade at all in a year. They're all model price derived. Sometimes model pricing may actually reflect what a dealer is willing to pay. So you can come up with a model derived price for a bond and you can say, okay, I'm going to pay that much. This is what fair value for this bond is. And a dealer comes along and says, yeah, that's fair value, but that's not what I'm going to pay. That's the fair value of the bond, but it does not represent the fair value of me holding the bond, the risk of me holding the bond in inventory. So sometimes the model will reflect a discount from these model-derived prices because it reflects what a dealer is willing to pay, thereby giving the illusion that the ETF price, depending on how it's priced, may appear to be trading at a premium or discount to its NAV. All right, so as I said on the previous screen, bond ETFs may appear to trade at a premium or discount. They appear to trade at a premium if the underlying model prices are too low, or at a discount if the underlying model prices are too high. Number 2, stale pricing of the ETF itself may appear to create a premium or discount. So if you have an ETF that doesn't trade very often, and let's say the last trade was 2 hours before the closing price, but the underlying kept trading, well, then it would appear to be at a premium or discount based on the last traded price of the ETF versus the closing price of the underlying. These next 2 charts I pulled out of Exhibit 9 and Exhibit 10 in the reading. And I think they're quite interesting. One is equity, and it's just comparing trading costs, primarily in the bid-ask spread between different ETFs. We have the SPY, the IVV, and the VOO. They're all based on the S&P 500. The S&P 500 has a futures contract on it. EUSA is the MSCI equal-weighted USA ETF. No futures contract on this one at all. And then you have the IWM, was the Russell 2000. It has a futures contract on it as well. Look at the average spread, 0%, 0.01%, 0.01. Look at for EUSA. Why? No underlying futures contract on the index itself, and IWM 0.01%. All very liquid ETFs. With the SPY, IVV, VOO, and IWM, and underlines, and again, the futures contract is there. Look at the median premium or discount, and I'll just draw this out. Almost non-existent, the median, except of course for the EUSA, and the maximum premium versus the maximum discount. We should expect to see the widest range over here, and we do. Head down to the bonds, TLT, this is treasuries. And for the other 2, they're high yield. And high yield, well, you're talking about corporate issues in there. Some of them will not trade at all in a given year. They're usually bought up very quickly by buy and hold investors, and then they're simply just not available. So a bond fund manager that needs to get exposure to a particular corporate bond segment of the market pretty much relies on ETFs. Look at the average spread, still very low, 0.01, 0.03, 0.01. Look at the median premium or discount. They appear to consistently trade at a premium. And again, it may appear that they're trading at a discount. And the more illiquid the underlying, the more it may appear to be so. These are both high yield indexes, JNK and HYG, 0.1%, 0.2% versus 0.03 for treasuries. And the maximum premium or discount, look at the range in all of these compared to, let's say, the SPY up here for equity, 0.12 to negative 0.19. These are a lot wider as well. And again, different market structures. The idea of, well, what's the closing price actually for SPY? Again, I think it's worth making this point. The ETF and the underlying all trade in the same market with the same closing time. So we should expect to see a median premium or discount of 0. We should expect to see very, very tight spreads on this one as well, and we do. Whereas with treasuries, you do have the average spread comparable with SPY. But again, you have these premiums or discounts that are much wider from the maximum to the minimum, and again, the median as well. So what may appear to be a premium or discount may simply just be a function of the structure of when these things are priced. All right, LOSF, describe costs of owning an ETF. And one thing I really like about this reading is they summarize the information so well in tables that I wish all readings, especially the narrative readings, I wish they would all do this. Because our job as we read through all of those words is to remove the unnecessary words and pare it down to just the necessary ones. And in the end, we're making these charts just in notes. So I really like it when the reading does it, because there it is right there, summarized and everything all in one place. So let's have a look at this first exhibit that we have on the screen, and I'll try to highlight the important points, and I'll do this. There we go, to separate the Y's from the N's. This is a function of the holding period, management fees, tracking error, you have portfolio turnover, taxables, gains, losses to the investor, securities lending. These costs are a function of the holding period, so that the longer you hold them, the more those costs really matter, like management fee or tracking error. Whereas these ones over here are not a function of the holding period. They only happen once. So commissions, bid-ask spread, the premium to discount or NAV. So if you're buying an ETF, you're going to pay some commission on the exchange for doing it. There's going to be some spread that you have to cross, and you might be paying a premium when you buy it. You might get lucky and you might be buying it at a discount as well. They can go both ways. But you only experience that once. So even if you hold it for a year, you only had those costs once, whereas these costs are continuing costs. Some are explicit, some are implicit. Explicit means you actually get a bill for it. You can actually see exactly what it cost you. Implicit means you don't get a bill for it. You don't really see how much it costs, but it's there in a drag on the return because there is a cost associated with those factors. And then it compares ETFs with mutual funds in terms of these particular costs. And since we're looking at the cost of ownership, what we want to do is look at where it's missing in the mutual fund, but belongs to the ETF. So commissions. When you buy an ETF on an exchange, you're paying the exchange commission. You have the bid-ask spread and the premium to discount or discount to NAV. Remember, with the mutual fund, they redeem and create all shares at net asset value at the end of the day. There's no bid-ask spread on that. You're getting the net asset value at the end of the day. And there's no commission because it's all part of the fee that you pay for the mutual fund. Your broker gets paid by the mutual fund company for putting you in the mutual fund. You don't pay the broker. When we're looking at the costs of an ETF, management fee, tracking error, of course, the mutual funds have that. Mutual funds have tracking error for index funds only. If you're an active fund, the idea of a tracking error doesn't make sense. The idea of active return makes more sense because you're not really tracking the index anymore. You're looking to really beat that index, right? If we're looking at our holding period, let's say that we're a particular type of trader. We can either be a short-term trader or a long-term investor. We'll be focused on different parts of that total trading cost. For instance, if we're a short-term trader, we're more interested in the commission and the bid-ask spread because everybody has to pay that no matter what. It is not a function of the holding period. If we're a long-term holder, then we want to look at the management fee and the tracking error because those costs continue on. They end up being a higher proportion of the total cost that we pay. So here's 3 holding periods, 3 months, 12 months, and 3 years, and it looks at the commission, the bid-ask spread, the management fee, and breaks it down. And well, it doesn't break it down. Sorry, let me get a better pen here. You have a total, and then it breaks it down into trading costs as a percentage of the total and management fees as a percentage of the total. So for a 3-month holding period, you're looking at 0.29%. 86% of that comes from just trading costs. Whereas if you're holding for 3 years, even though you face the same commission, the same bid-ask spread, only 36% of your total costs come from trading costs. The management fees end up being far more important in the long term. So when you look at the cost structure of an ETF, if you're a short-term trader, you're really looking at that bid-ask spread and the commissions that you have to pay to move in and out of that thing. If you're adding it to a portfolio saying, I don't want to add the underlying, I'm going to get underlying exposure through the ETF, and it's going to be part of my strategic asset allocation, which means I'm going to hold it for 2, 3, 4 years, then you really want to pay more attention to the management fees that you're going to pay. The trading cost of moving into it and out of it really are not that important because you're only going to do it once. once 3 years ago, maybe once 3 years from now, as opposed to an active trader who's moving in and out of these things. All right, next one, LOSG, describe types of ETF risks. And they're not, I don't know that we would call these real risks that we would spend a lot of time assessing. They're risks of particular types of ETFs. However, it is not complete to discuss a particular security without at least being aware of the risks that exist for them. But these risks are, in my opinion, they're minimal and they're really segregated to specific types of ETFs. Number one, counterparty risk. Some ETF structures involve reliance on a counterparty. ETNs, exchange-traded notes, are a good example of this. An exchange-traded note is an unsecured debt obligation of the issuer, and typically it's a bank. And as a bank wants to add debt onto its balance sheets, it will issue ETNs. When it no longer wants to add any more debt on its balance sheets, it will stop issuing ETNs. Well, what is the underlying of the ETN? An unsecured debt obligation of the bank. So there's a counterparty to the other side. It's not some security representing an ownership of something or some security that's a debt obligation of a corporation. It is a direct debt of the issuer. Settlement risk, when an ETF uses OTC derivatives. Notice it's not exchange trade derivatives, but uses OTC derivatives. And securities lending, we lend, an ETF lends its securities out. It gets cash collateral, somewhere between 102 to 105% of the security value that it lent out. So it minimizes that risk, but there's always the risk that whoever you lent the securities to will not be in a position to return those securities. Fund closures, this is a more common risk. Fund closures due to, and we have a bunch of things here, regulation, competition, corporate actions, creation halts, and change in investment strategy. So something due to regulation. Regulation may come along and say, okay, this type of structure for an ETF, no more of that. We can't use this anymore. So it would have to wind up operations, close business. Competition. A company, a sponsor, can introduce an ETF, but if nobody buys the ETF, and if there's too much competition in a particular space for ETFs that track a particular index, well, some of them aren't going to get the critical volume they need to be profitable. Corporate actions, M&A. One company that has a bunch of ETFs buys another company that has a bunch of ETFs. Maybe there's overlap in a couple of them. Well, shut one down. Creation halts, mostly for ETNs, what I described up here, when the bank feels that it has enough debt on its books and it doesn't want to issue anymore. It does not have to create any more new ETFs. In that particular case, arbitrage breaks down because the authorized participants can't engage in the redemption creation process if there's no more creation from the ETF sponsor. And a change in investment strategy. So an ETF may say, well, you know what, we used to do it this way, but now we're going to do it a different way. So there's a risk that you bought ETF to get exposure to a particular type of risk factor, a particular type of market segment, and that's going to change. Any of these A, B, C, D, E can trigger capital gains because things have to be sold, which means you may have a capital gains tax obligation that you didn't want, that you were unprepared for. It might even be a combination of long-term and short-term capital gains, and the short-term capital gains are taxed at an income rate, not a capital gains rate, which makes it even worse. And there's also the need to find a replacement investment. But this is a risk of holding any stock. I remember I bought a stock once for a REIT that I thought was going to be a nice long-term hold. It had a nice dividend yield. Its dividend payout ratio was well under 100%. And I thought, okay, well, let's stay in this one for a while. 3 months later, it got taken out. It got taken out at a premium. I did okay on that. But the problem was, well, there were two problems. Number one, it created a short-term capital gain for me. So I no longer had a lower-term capital gains tax on that. I had to claim that capital gain as income, which means half of it was going to disappear right away in taxes. That was a done deal. 50% tax rate, if well, marginally a little higher than 50% gone. So that was a bit of a hit. Not only that, now I had to go hunting for another investment to put it in. After looking around for a period of time and finding that one, all the work that you did, all of that effort that you did to find that one, well, now you got to throw it out and you got to start over again. So think about a company that manages money for a lot of clients and has them in some ETFs. And now they have to find something else. Well, that kind of research, to put them in something else, costs money. So the combination of ending up with a capital gain that I didn't want, in a form I might not have wanted it in, and have to engage in the research process all over again, well, that's a bit of a drag. So that, I would say, is probably a more real risk. Investor-related risks, and here's a big one, the lack of understanding of your underlying exposure. And this is particularly for leveraged and inverse ETFs that return 2 times or 3 times the daily return. Some people think that, well, if I hold this, I'll get double the return of the index, or triple the return of the index. And the answer is no, you won't. You'll get double the daily return depending on the path that thing takes. Even if the index goes up, you could still lose money depending on the path. So that's a big risk here, is just the lack of understanding of what they're holding, especially the leveraged and the inverse ETFs. All right, LOSH, identify and describe portfolio uses of ETFs. And for this one, I'm really just going to use 3 screenshots of the tables that are in the reading, because it summarizes each section completely. And for each one, there's a lot of words, and the writing is kind of dry in this final section. It's really boring. So these tables that it puts up, I think, are absolutely imperative, especially when you have these narrative readings. An author that does this, I think, okay, that's a good thing that you've done here, because really it comes down to this. So let's have a look. Portfolio application, role in the portfolio, and examples of the ETFs by benchmark. For portfolio application, cash equitization or liquidity management. Cash equitization means that you have cash in your portfolio and you want to put it into equities. That's why it's called equitization. You want to put it to work. But maybe you don't have enough. Maybe you want to buy securities in a certain ratio, or maintain certain weightings in your portfolio, and you simply don't have enough cash to get that done. So you can buy ETFs that represent a more diversified portfolio than if you only had enough money to buy maybe 1 or 2 different names. So you could use the ETFs. Minimize cash drag by staying fully invested to benchmark exposure, and it allows you to transact small cash flows. Portfolio rebalancing. So let's say that you have a portfolio, and I'll just draw a little circle to represent a portfolio, and I'll put it like this, and let's say those are your equities. Here's your bonds, and here's everything else, meaning some cash, some commodities, maybe some alternative investments as well. And you need to rebalance back to an equity weighting and rebalance back to a bond weighting. Maybe your weightings are a little off. Well, rather than buy and sell on each one, if you need to lower your equity weightings, you can always short an ETF in there, and you can always just buy a bond ETF to get you back to the exposures that you want, as opposed to transacting in the underlying. Portfolio completion. This is to fill gaps in your strategic exposure. So let's say, again, this is the equity portion of your portfolio, and you decide that it's going to look like this. Here's your domestic, and you're going to have some international exposure. And for the domestic exposure, you're fairly up on which securities that you want to hold there. But for international exposure, you're really not too sure. And in international exposure, let's say that it looks like this, and you want to divide it between Europe, Asia, and let's say Africa. Well, you can get ETFs that give you exposure to each of these within the international sector, as opposed to doing a lot of research in markets that you may not be too familiar with. Manager transition activity. And this one here is really important. Let's say that you have a manager managing, let's say, $100 million portfolio, small cap or mid cap stocks, and they're not performing very well, and you want to switch to another manager. Well, that manager has to hand over the cash to the next portfolio manager. Well, rather than go all to cash, hand over the cash, and then deploy the cash, what the small cap manager can do is say, well, what I'm going to do is I'm going to move all of that into an ETF. That gets you exposure, and let's say this is the second manager here. Manager 1 will move it into an ETF that gets it exposure to what manager 2 is eventually going to deploy the cash in. So let's say it's going to be mid-cap stocks. We'll buy an ETF that has exposure to mid-cap stocks. Manager 2 will receive all of these ETFs, and then it can slowly sell the ETFs to buy the underlying exposures that it wants. So it has time to move into the positions it wants, and at all times the money is fully invested and realizing the return of the exposure that it wanted. All right, the second category we're going to look at for ETFs and portfolio management deal with asset class exposure management. And we have three applications here: core asset class or market, equity style, country or sector, fixed income or commodity segment, and this one here, a theme, an investment theme. So we can use ETFs to gain our core exposure from our strategic asset allocation. Perhaps we have 40% equities, 40% bonds, and within bonds we have 30% investment grade, 10% high yield. Well, it's going to be hard to get that high yield exposure efficiently. We may just use an ETF to get that core exposure. So it can be used as part of the strategic asset allocation, or it can be used tactically. We might decide that if we're coming out of a contraction into an expansion, rather than having a 10% weighting in our bonds to high yield, we might want 20%. So we would add to that ETF and perhaps short a treasury ETF at the same time to lower our exposure there. Core long-term strategic weighting, tactical tilt to enhance returns or modify risk, ease of access versus buying the underlying securities, especially with fixed income. The equity style, country or sector, and for fixed income or commodity segments, again, strategic or tactical. We may decide that we want commodity exposure for 5% of our portfolio, but really don't want to be in commodity equities such as mining companies, etc. We want commodity exposure without having to get into derivatives and futures. ETFs are a great way to get that. Tactical tilt to enhance returns or modify risk depending on short-term views. Hedge index exposure of active stocks or bond strategy, ease of access versus buying the underlying securities. And finally, thematic investing. Maybe we have an idea about a specific sub-industry in the technology sector, or perhaps we want to gain exposure to a REIT ETF for a period of time. And here we have dynamic or tactical. Because it's thematic, we wouldn't really consider it part of the strategic asset allocation. We may have 40% equities as part of our strategic asset allocation with 10% dedicated towards, or 5% dedicated towards a specific theme that we think, or a specific sub-industry that we think will do well. Here's some good examples of ETFs by benchmark type: technology, financials, oil and gas, biotech, infrastructure, robotics, gold mining, buybacks, internet innovation, cybersecurity. You can see all the themes in there. Tactical or dynamic, active tilt to enhance returns or modify risk. Efficient implementation of a thematic industry versus a single stock view. So maybe we like the idea of cybersecurity and we know 5 or 6 firms, but we have enough money to buy one. It doesn't make sense. We're not diversified enough. Find an ETF that does that for us. Capture performance on an emerging theme or innovation not reflected in industry categories. And the third category we'll look at for the role of ETFs in portfolio management: active and factor investing. First one, to gain factor exposure. This can be used strategically, dynamically, or tactically. Capture risk premium from one or more factors driving returns or risk. We can think of small cap, value, growth, large cap, etc. Second one, risk management. Here we would use it to adjust equity beta, duration, credit, or currency risk. So we may have a portfolio which has a beta, let's say we're 50% equity, 50% bonds. The equity has a beta of 1.1. and bonds have a duration, let's say, of 4. And we want to move a little bit out of equities and more into bonds, and we want to lengthen the duration of the bonds rather than buying and selling the underlying. We could leave it pretty much in place and just add ETFs to that. We could short a broad market equity ETF to lower our equity beta, and we could add ETFs that add duration to our portfolio. Leveraged and inverse exposure, and here we see that that would be used tactically. Nobody really has, as part of their strategic asset allocation, the idea of a leveraged exposure to an asset class or an inverse exposure to an asset class. This would be used at particular times where we think, you know what, we think that this is really going to outperform. Let's get not just a regular ETF, let's get a leveraged ETF. And We got to be careful with these leveraged ETFs, right? They return a daily leveraged return, not over a period of time. And of course, inverse exposure. The inverse exposure, we think, well, why do you need an inverse exposure if you could always just go short the ETF? There may be restrictions on going short an ETF. For example, inside a registered account, typically no short positions. However, you can hold a long position in an ETF that is itself short. So it gives you more ability to take a short position when the IPS has a restriction against short positions. Now, that's not really in the spirit of the IPS, but it's not a short position. Alternative weighting. An alternative weighting would be, let's say that I want, of my equities, I want 10% exposure to REITs, and we have a REIT ETF that probably is going to be market cap weighted. We may be able to find an ETF that is dividend weighted, so that it has a higher income yield than just a market cap weighted ETF. So you can use alternative weightings to get greater exposure to the one fundamental thing that you want. Active strategies within an asset class. Most ETFs are passive. Here's the index, here's the holdings, I'm going to track this index, here's a nice cheap way for you to gain index exposure. However, there are some ETFs that do engage in active management, so you can get exposure to that. And the last one, dynamic asset allocation and multi-asset strategies. You can get ETFs that are themselves diversified across multiple asset classes, as opposed to building, let's take some bond ETFs, let's take some equity ETFs, let's take some commodity ETFs. As opposed to building yourself with different ETFs, you can get it all in one product. And that wraps up this reading.